morning and welcome to our latest virtual roundtable brought to you by Bridging & Commercial and kindly sponsored by PMJ Capital. Thank you very much for joining us today. My name is Beth Fisher. I'm the editor at MediaNet with the online titles Bridging & Commercial and Development Finance Today and the bi-monthly print Bridging & Commercial magazine. Today, we will be discussing how to know whether a bridging lender can deliver on its promises. There are many parties involved in a bridging loan transaction, as I'm sure you're all aware, and it is imperative that we all understand the expectations that need to be met from the start. This usually means relying on strong, realistic, and transparent communication, tried and trusted relationships, technology to streamline things, and lots of clarity. While it was clear and understandable that service levels slipped at the start of the pandemic, SLAs are still somewhat of a grey area. Earlier this year, a survey of over 100 participants conducted by B&C reported that almost 80% of brokers felt that bridging lenders needed to be clearer on loan completion timescales in order to manage clients' expectations. It was urged that more onus needed to be placed on the advisor in working out each lender's process and requirements, and to do their due diligence in every area of the deal, including homework on the lenders they do business with. Questions they should be asking are, do they charge default fees? If they do, how? What is their approach to extensions and flexibility when things go wrong? How clear are their processes? Do they have strong and established relationships with solicitors and valuers? Who makes the final credit decision? Is their funding committed and ready to be deployed, or do they have to get approval from their funders? These are the sorts of questions brokers should know the answers to with all the lenders that they work with, or they could risk losing valuable clients. With more mortgage brokers entering the specialist finance space as a result of restricted criteria from the mainstream banks and bridging lenders desperate to win business following a volatile year, thoroughly understanding which providers are over-promising and under-delivering has never been more important. I'm keen to find out from our panel today how they assess the capabilities of a lender, what is integral to them and their clients when sourcing finance, and what improvements can be made in our industry to increase certainty of execution. Joining me to discuss today's topic are a fantastic group of experts in the bridging market, and I will now hand this over to them so they can each spend around 2 minutes of their time introducing themselves. And I'd like to start with Stuart, please.
Morning, everybody. My name's Stuart said, I'm a director of PMJ Capital. I'm one of the founding shareholders. My role principally is to make sure that we have the cash available to do the deals that we've agreed to, which I think is probably one of the fundamental things that we need to discuss today. So that's me, and welcome everybody.
Thanks very much for that, Stuart. And Dave?
Yeah, so I'm MD of PMJ Capital. So we're a specialist property finance provider, privately owned, principal lender, been going around 6 years. Alongside that, I'm also property finance director at Cowgirls, where I'm sort of concentrating on larger developments and portfolio cases, but have the benefit then of the perspective from both lender and broker side, which I think is important. So I do sympathise with issues when they do arise.
Thanks for that, Dave. Nina?
Good morning, everyone. Nina Scott from 2XL Commercial Finance. We are a whole of market commercial finance broker. Myself, I've been in the industry for about 13 years, coming as a trainee. So all I've ever known for my working career is commercial brokering. 2XL have been established for about 15 years, established by our MD Darren Willoughby and one of the directors Tim Baumber. We now have 7 directors covering 7 offices around the country, assisting clients with any type of business finance inquiry, although we do seem to have a steer towards property just by the inquiries that you get. Done a lot of bridging over the years, and I would happily say the good, the bad and the ugly. So yes, very intrigued for today's conversation.
Thanks for that, Nina. John?
Thanks, Beth. Hello, everybody. My name is John McNamara. I'm the Head of Real Estate Development Finance Focus Commercial, and we structure as a broker property finance and equity requirements for property developers for each stage of the life cycle process, which includes acquisition, refurbishment, development and development exit. And we want to structure the deals for the lender and the client so they run smoothly. So I was very interested in today's panel, so thanks for the invite.
Thanks for that, John. Bridget?
Good morning, everyone. My name is Bridget Kibiru. I work with Orion Finance. We are a specialist property finance broker. We're based in Milton Keynes. We specialise in all forms of property finance. We do get a lot of development finance purely because we have a lot of a big professional team around us, from architects to solicitors, conveyancing team that we bring to the table for the client. We also specialise in equity finance, which again is a specialist product for a lot of developers, either just looking to grow or just new into the market. I have been in finance myself since I finished uni. I don't want to say how long, telling my age, it's 10 years plus. But yes, I'm very excited to be part of this fantastic panel, and it will be lovely to discuss the bridging. Again, I'll say like Nina, the bad, the good and the ugly. It will be really, really interesting looking at the agenda that you've got ahead for us, Beth.
Thanks so much for that, Bridget. And last but definitely not least, Mark.
Good morning, everybody. How are you? You okay? Thanks so much, Beth, and thanks so much, Dave and PMJ, for the invite to join the panel. I'm looking forward to discussions this morning. My name is Mark Mcbride. I'm the founding partner of Adapt Finance, which we run with my son Jordan, my lifelong business partner Steve Burns, and ex-bank manager Graham Ball. We specifically work within the bridging development market. We've had some reasonable success since starting the company in 2014, and hopefully that'll continue in this ongoing years. But hopefully, reaching my 32nd year in the industry, I'm hoping to be retiring away from it and John can carry the baton ongoing. I think as a company, we pride ourselves on relationships with lenders and industry professionals and direct to client. I'm very interested to sort of hear what people's views are in the market at the moment, because I think the daily commitment of new lenders to the marketplace and over commitments and over promising could cause an issue to us all. I think it's interesting to hear like-minded professionals in the industry to get a feel for their views and perhaps a way we can steer the industry ongoing.
Thanks very much for that, Mark. And I just before we kick off with our first few questions, I just want to remind the audience today that on the side of your screen you should have a little control panel, and there is a chat box there. Please do feel free to ask your questions throughout the conversation. I will be checking these and asking them as and when, and leaving the last 5 to 10 minutes to ask any final questions from the audience. So please feel free to ask any of our panelists directly, or just a general question, so I can look through those. Okay, great. I will start with my first question, which is really all about the bar to entry in the bridging lending market, which everyone knows is fairly low, which means that the amount of lenders in our space has been constantly expanding. So I'd like to know what the biggest benefits and challenges of this are for existing lenders and also the broker community. David, do you want to kick us off on what the biggest benefits and challenges are for lenders?
Well, I mean, I think choice and diversity is good for everybody. There's a lot of people, a lot of new entrants coming to the market, all trying to demonstrate a competitive advantage. So it keeps the existing lenders on their toes. I mean, you know, remember PMJ Capital, we started this 6 years ago, so you know we are relatively young ourselves, and understand that we had to make our mark when we came into the industry. I think the are we doing benefits and pitfalls, or just benefits at the moment, Beth? Benefits and pitfalls, fine. The danger is, as new entrants come into the market, you then get the existing lenders trying to react, arguably as opposed to sticking to their guns or sticking to what they're good at. And as I said, well, while choice is great, the danger then is that service gets diluted, the messages to the broker community get confused, and ultimately the client and the broker then suffers, because you've got lenders trying to be everything to everyone, and you find a lack of experience then results in a mismatch between the sales guys and the credit, and it all all too often ends in a deal not going ahead and a client being exceptionally unhappy, and a very costly experience.
Thanks for that, Dave. Nina, from your experience, on the broker side, what are you seeing in terms of, new lenders coming in and the competition, biting the heels at the existing lenders?
Yeah, I think it's as Dave was saying, there's no harm in having choice. It's always a great thing. I think it's interesting to see what the new lenders come out with, and I think as the other brokers on the panel will probably echo, when you've been doing it for a while, you kind of get to know the new lenders when they're coming in and what they're coming in with as to whether it's going to be deliverable. And when they'll either come in with a fantastic rate, which is something that's not seen by the bridging lenders and makes you question whether it's achievable. So yeah, it's great to have choice, but I think it's then seeing how that transpires going forward.
John, what kind of challenges do you see in terms of, a growing lender market?
I would say the new entrants into the market, we're a little bit susceptible to them, because we need track record with them that we've done deals with before and with the existing lenders, and trust and delivery. At the end of the day, we've got a brand and our reputation, and some lenders could damage that who can't perform. And I think it's a risk to not only my reputation and my company's reputation. I think they've got to deliver. So it just work with the new lenders, but the big thing for me with the new lenders is who their key personnel is. A lot of the new lenders now have got existing personnel from other lenders in the market, and that's where the trust comes into it. As you can see, the last few years we've had peer-to-peer lenders who have not really understood property. They've been more or less IT guys, and they collapsed quite quickly, really, which left a bad reputation in the bridging market. So that's where we're at. We go on trust and delivery, to be honest.
Mark, what would you add to that? I see you shaking your head.
Well, I totally agree with John with all of it. I think the number of lenders going to market is worrying, to be honest with you. I don't think it's doing the market any good. I think it's pushing people into putting money into the market that's, with respect, not profitable for them. I think it's unsustainable, and I think it's something that long term will have an effect. Our business, we know John very well. Our business mirrors John's very much so. We are direct to client. It's very, very important that we maintain, we deliver monies to clients. And I think the only time we look at potential new lenders as such is, like John mentioned then, is when there's a person we have a relationship, and this probably sounds disrespectful when I say it, and I'm not talking at BDM level here, I'm talking at decision-making level, who moves on and gives us the comfort that the money is deliverable and will be able to tell us where the money's coming from and how this process is going to work. Typically, they'll mirror the same professional involvement with solicitors, QSs and whatever. That gives me comfort. Somebody just ringing me and offering him a silly rate on a Tuesday morning, with respect, doesn't appeal to me at all. And with respect, I think it's doing more damage than good. And I'm really strong to try and get to a point where you, as the voice of the industry, Beth, and your peers, are able to try and sort of give a message across the market that, it's down to looking after clients, and what clients want is monies to make sure their projects, their developments, their sites work, and that's not always the cheapest money by any stage.
completely agree, and I hear that a lot. It's definitely, even though the bar to entry is low in the, for lenders, it's very challenging for new lenders to get their foot in the door with good brokers, because like you say, this industry is built on trust. So having a niche is definitely worth bringing into the market. You need that. You can't just have service and rates. But the trust is there, and to do that, you need good people, and that costs money. So it's definitely a challenge for new lenders to come in. And you guys have touched upon it already a bit about headline rates. I think Nina, you mentioned that headline LTVs, fees or no fees, and headline turnaround times. They're often used by lenders to promote their propositions. So Bridget, how are brokers deciphering who can actually deliver on these in order to manage your clients' expectations?
So headline rates, we look at it more like just trying to grab your attention. I don't think it's any different to a new lender coming into the market with a bit of money and trying to get brokers in to send them business. For us, the main thing goes back to what everyone has said in a way, which is the relationship that you've got with the lender. The headline rate does not mean very much for us, unfortunately, or high loan to values, purely because something like a high loan to value on a nursing home, for example, is never going to happen. Nobody's going to do it. It will always go back down to the valuer has come back, and we should have known this from day one. So for us, it goes down to, have we got experience with this lender? Do we know the people there quite well? Do we have a good relationship with the lender? It all starts with the BDM, but it has to go a lot deeper than the BDM. It has to go a lot deeper to the, as Mark said, the QS team. It has to go down to the credit team. And I think you have to know the lender inside out, other than the BDM. I personally love a meeting when someone is giving a low loan to value, where they can bring in somebody else in the team, like an underwriter, to just give a different view. That for me always gives me confidence, and as such, I'm happier to build that relationship and take it forward. Our business is mainly on referrals from our developers. We cannot afford to let them down. So a good headline rate is brilliant, but it has to go down to the relationship with the lender.
Nina, what would you add to that in terms of how often these kind of headline USPs actually come to fruition?
Yeah, it's an interesting one. I'm not. I think they do. As we said, some lenders can get a good funding line in, and it is there to offer. But I think it's interesting to when Shawbrook decided they were doing bridging lending, and transpired it's not bridging lending at all. It's just short-term lending at buy-to-let rates. Which is good, but it's managing the expectations of the clients. I think the hardest thing with the headline rates can sometimes be getting clients to understand rate, deliverable, actually delivering it, and turnaround times don't always necessarily go together. And I think that can sometimes be the harder part, is where clients are expecting the best rate on the market with the speediest turnaround times, and it's an education process to get them to understand that not necessarily all of it align. And at the end of the day, bridging and development finance is often down to who can deliver, rather than getting the best rate.
Out of interest for everyone on the panel, like with the amount of headline USPs, as I've reeled off earlier, that are in the market, does this confuse your borrowers from a broker perspective? Like, do they see like headline rates and then question why they're not being presented with certain costs? Mark, you're obviously direct to customer, so I'd be interested to see kind of what your customers are seeing and what they kind of expect.
think again, Beth, it's the confidence in us as a broker to how we deliver to the client. You know, with the best will in the world, I think if we were in a marketplace or individual as a company that were driven by rate, I don't think we'd be here at the end of the day. You know, we have to give or get the confidence from the client that we know what we do, and we believe we're industry professionals in what we do. Going back to just slightly touching on what the girls were saying earlier, and what I don't understand with lenders, and I say this so many times to people who come and knock on our door and talk to us, tell me the end, tell me the problems at the end. What's your credit line? What's your attitude towards extensions, defaults? That means more to my client, because let me tell you, we're not in a perfect world. We're in a less perfect world than we've ever been in. And one of the biggest concerns to me is what happens to the client if we have an overrun, if the gas can't be turned on, whatever. Don't tell me your rate. Let me carry your rate. If I believe we can carry it, I'll carry your rate. Tell me what happens at the end, because to me, that's the biggest pitfall of the industry. And that's, in my opinion, if lenders were more transparent regarding the end parts rather than the front parts, the industry will work a lot easier and clients will be looked after better.
Thanks for that, Mark. I would like to find out what you all think about how the pandemic has resulted in more lenders potentially being a bit more desperate to win business to make up for last year, and also consequently over-promising and under-delivering. Stuart, do you have anything to add in that respect?
I think from our perspective, it was obviously the first lockdown kind of kicked in and you start to think what's going to happen, you know, and I'm pretty sure when I say this there that we just never stopped wanting throughout the pandemic. I don't think we had any particular kind of desire to increase business or to reduce business through that period. I think we just carried on as normal day for me. And so I think it's, and I don't know why that's kind of particularly been prevalent, Beth, to be honest, because we just haven't moved from where we were. And I think if you set out your kind of stall in the first place before you start business, then I think you should be able to cope with things like this without having to kind of pivot unnecessarily. So for me, it's been pretty much business as normal.
Can I jump in there, Beth? Yeah. I mean, Stuart's right. I mean, you know, we just carried on as normal during the pandemic, and that wasn't born out of any particular strategy other than we are sensible people, we've got experience, and the last thing you want to do during a pandemic is knee-jerk. The last thing you want to do is pull a plug from a developer when you are far better working with that client to get to the end and get a saleable product for everybody. And then it comes down to what everybody's been saying, is who is in control, who's pulling the strings, and who makes the decisions. And if those decisions are being made by people who, you know, brokers, introducers cannot have a conversation with, then I'm a little bit concerned. From our point of view, we don't have credit committees. You speak to myself, you speak to Lee Barton, and we make a decision, and that's the decision. That is subject to the usual legal and valuation due diligence. That is a credit decision made. That gives confidence for the broker, it gives confidence for the client, but then it extends far beyond that, because it's okay doing the deal and getting the money out on day one. What happens afterwards? What happens when something doesn't go to plan, there's a cost overrun, you know, there's the contractor's gone bust, or a time delay or whatever? Who is a broker and the client then going to speak to? They need to be able to speak to a decision maker. They need to be able to speak to somebody who knows the deal from day one, who's met the client at the outset, and is not controlled by a funder in the background who is getting nervous because they are new to funding a bridging lender. We need to be in control of our destiny as a lender, and that is to the benefit of the client. Hence, go back to the previous question. You know, LTVs, cheap pricing, it's all a smokescreen. It's a race to the bottom, and it's a race to the bottom by people who do not necessarily have the experience to stand the ground and explain themselves as a lender and their credentials, who is in control, who makes the decision, and that is the the key for the client, the litmus test has got to be delivery, and it's always going to be delivery.
That's 100%, absolutely 100% correct.
Can I just make a point there? I mean, most of us here have probably been through the credit crunch, the pandemic and Brexit. I think experience is key. So when the pandemic come, I knew that the lenders would be a little bit cautious, but the likes of the peer-to-peer, which we don't use much, would suffer with their, going back to the first point that we raised about the funding level, the funding lines, they took the hit first, to be honest. But during the pandemic, we had a number of loans with one lender who we've got a great relationship with, and we were in constant communication with them, because once the loan is being drawn down, that's not the end of the communication for that client or the loan. We were informing about the cost, about the overruns, on the project, because the sites were shut down. That lender honoured all my clients, never charged them any default fees or any other fees. They were accredited themselves, and I think they're going to get the fruits of their labour now with the likes of myself, with even more business and even the clients.
I think a number of us, John, on this call, back to kind of 2008, went through the credit crunch, and Dave, with his kind of banking background at Bank of Ireland,
yeah,
how can a knee-jerk reaction just do not do anybody any good in this climate? So I think just kind of understanding what happened there, I think it's put everyone in a pretty good position, really.
Can I just add to that, Beth? You know, in this lending market, lenders have got to be there for the medium term. And if you try, and pardon the phrase, screw somebody at the end of the deal and try and charge default rates where, there's been something that's not outside of anybody's control. Take the pandemic, material shortages, time delays, people couldn't sell quickly because estate agents were shut. It was the right thing to do to stick with them. It was the right thing to do not to charge penal rates, because those clients were digging in as well. And where a client digs in, the lender's got to dig in. And by doing that, that client comes back for his second and third deal. So it benefits me as a business and as a lender. I've got longevity with brokers and broker relationships and client relationships.
It's a really interesting point, and I hear it often. The market is short-term in nature, and therefore some lenders may have a very kind of short-sighted view of business, where really they should be looking at the long term and actually the valuable clients and broker business that they get and how they act in the interim. So it's a really important point there, which kind of brings me on to my next question about what kind of questions brokers should be asking when it comes to using new bridging lenders and existing, because products change and criteria changes, and as you've all mentioned, funding lines change. We've seen a lot of institutional funding come into the space. So in order to protect your clients' interests, what questions should you be asking? Bridget, do you want to kick us off with that?
Sure. Yeah, can you hear me? Yeah. Absolutely. The question that I would like to ask, or I do ask actually all the lenders, is what is behind the proposal? You want to know everything that is behind that, because it takes you all the way to the end in terms of what is the process like, what does the client want? It all starts with what the client needs before you can actually manage their expectations. And as a lender, I would like them to manage my expectations as well. Honesty, transparency is what we want from a lender. As Matt said, we can carry the rate to a client. It's not a problem. We just need to be absolutely confident that this product will be delivered, especially when you're very specialist in the products that you offer. Problem properties or all those kind of things that make you specialist. It's not they could potentially go to a lender and get 0.39 easily if it was just residential house, 3-bedroom detached, just go and get it. But we don't deal with that. We deal with a lot more complex things. So we like a lender to come in and just show us what is behind there, whether it's bad, whether it's good, whether it's really difficult for us to sort of stomach, we will be more than happy, and we will appreciate them for being more honest. Because as long as the client is aware what we're going to deal with or the journey, the client will buy in and everyone will be happy and everyone will be singing to the same tune. It is a huge problem when you get told one thing by the person who's the face of the lending company, and then you speak to somebody else on the phone when you've submitted the paperwork, and it's almost like two different companies. Very frustrating. I like to understand what I'm dealing with. If I do, I can deliver it to the client. If I don't understand what's going on, because I told the client something different day one because of what I was told, and then now I'm having to go in with a totally different story, the client will not trust me, but we cannot afford to lose a client through that way. So it's all about knowing exactly what's behind the scenes, how everything works, what are the timescales like, who is the team behind it. Once we have all that information, then it's all hands on deck and we can go. But before we have that, it's very difficult to get in bed with a lender.
Really interesting points there, Bridget. And I think that's why we've probably seen a rise in lenders having the kind of hybrid relationship manager role come in rather than just BDMs and underwriters, and they kind of do the whole kind of cradle to grave deals that they're actually giving terms at the beginning which they can deliver to. So I think it'll be interesting to see how teams evolve. Yeah. Nina, what would you add to that? Any other questions you think that brokers should be asking, especially new mortgage brokers who are entering the bridging space?
I think it's very similar to what Bridget said. It's understanding the journey, not only the customer journeys in what information is going to be needed, what's the process, but also the internal journey. So who is the decision maker? Do we get to speak to that decision maker? How many people are in the chain to get to that decision? How quickly do we get to that decision? So as Bridget said, we know from the outset what's going to be needed, and we can make sure that that happens for the client and everything is delivered when it needs to be. I think it's useful to understand the valuers that they use, the QSs that they use, the other professionals that are involved, the solicitors that they use, because sometimes that can give a bit more of an insight into how the case is going to progress if they've got specific requirements on valuers and solicitors from previous experiences that we've had.
We always ask, it's a standing question, which brokers have completed work with you? Because there's names that we get thrown in the industry, and if you throw a name in who we know, we trust, and we know that they do the job right, it gives us a good gauge that they can do work. You know, John and I and Steve have many conversations regarding lenders. You know, it's not very often we come across the same clients with the best work in the world. There's enough work for us for everybody. Right. But I think to have that confidence to say, you know, I've done some work with John, I pick the phone and John says, yeah, they've been great to work with, it gives me confidence at the end of the day. And I don't think we need to be isolated. There's a lot of work out there. You know, let's share information and let's get the good lenders more work and the poor lenders less work, and then we all benefit from it at the end of the day.
Yeah, totally agree, Mark.
That's really interesting.
Can I just give it from the lender's perspective? And that all I would say from a lender's perspective is, don't be afraid to ask the questions. Ask the lender, you know, who makes the decisions? As Nina says, you know, what's that chain like? Who has the final sign off? Who signs off that valuation report? Who signs off the report and title? Who's involved in that process? And if you ask direct questions and don't get direct answers with clarity, then you know that it's going to be tortuous throughout the process. If a lender can give you that clarity, the answer may be no, but if they can answer the question with clarity, then you can get a good gauge for how that transaction is going to pan out.
Great point, David.
With communication, and obviously we've been speaking about transparency, to be realistic about loan terms and timescales. Do you think the bridging market needs to see improvement in terms of communication and transparency?
I do myself with in the bridging industry at the moment. I mean, we had a deal a couple of weeks ago, It sent it to a couple of our lenders. And we needed to have it completed within a week, within 7 days. And as a broker, we packaged it up correctly with the legals, the numbers, the application, everything in there. And to be honest, we struggled. I know it was during this SDLT time, but we struggled for a bridge to get completed within a week. I don't know if that's because expectations or the volume with the current lenders, but many years ago when I started, the asset type lender of bridges, you could complete that within 3 or 4 days. And I think myself, that's what's missed in the industry now. Going back to rate again, it's not always about the cheapest rate. It's people will pay a daily rate as long as they can deliver and do it quickly for their property needs, because they might have a property that they've got to buy in within 3 or 4 days for a great deal. And I think that's what's lacking in the market now at the moment.
I think from a lender's perspective, and Dave will probably know this as well as I, is our kind of delays from a PMJ Capital perspective often lie with the borrower's solicitor. What quite often happens is the borrower will use their family solicitor or just somebody that they've known for years, don't have the bridging experience, and that for us is the most frustrating aspect of it, really. Dave?
Yeah, I mean, I think to me this all starts with the broker and lender relationship. If there is complete transparency and honesty there, if the case is presented in the right way, and know you guys on the panel, when we get something from you, it's presented well. You've got the information to make a decision, and that's a great base to start with. If there's an issue there, get it out on the table. Then we're all aware of it, and it's not going to bite us. 2 days from completion. It makes common business sense. If you want a good relationship with a lender, tell us warts and all. We can then make a decision. And you guys will have had time and time again, terms coming back from a lender, and you think, well, how's that happened? How have they reacted so quickly? Are they just putting out a term sheet in the hope that it will bring somebody into a conversation and will drag a deal across the line? Timescales are important. It comes down to asking the questions, getting an honest answer. How does your legal process work? What is the communication during that process? I can quite honestly say, throughout a legal process, if the broker wants to be copied in the correspondence, great, let the broker be copied in the correspondence. I see all the correspondence, so I can jump in, and the lender should be jumping in when he sees something to either sort out a problem, provide some clarity, and it doesn't get bogged down in that email ping pong between 2 sets of solicitors, because we all know that's where a lot of the delays happen. And if there is points then that need expanding on or clarity, you can do that, but do it at the right point in time, not when we get to the client thinking I'm completing on Friday and the lender turns around on Thursday and says, well, I need all these 6, 7, 8 points. We should never ever get in that position if we're communicating throughout the process.
Well, do you not think a lot of the time, again, probably blaming us as brokers now? The transparency to us is I think most of the time, is pretty typical. I think it's down to the broker to manage the expectations of the completions. I mean, in times like at the moment where, land registry searches can be taking 6 weeks and whatever, and you can have problems we've never had in this industry. I'll get a call from a new client and say, I've got a guy who can get me the money in 3 days. Well, he can't get you the money in 3 days. So, that's a flaw to the industry. And it's down to us as brokers who are carrying this to clients to manage their expectations. Get them to speak to the solicitor. Get them to find out whether the lender will take an indemnity. Let's go down the avenues we should be steering them down, rather than just plumbing up with plucking dates out of the air. Because at the end of the day, I don't know how everybody else's business works. We get paid on delivery. We get paid at the end when something completes. So it's as much in my interest for it to complete as it is the client's. So make sure we start at day one on the right footing, knowing that the completion date is realistic, And hopefully, if that happens, we deliver the case to you as the lender in the format you want it. We instruct the solicitors in the way they need to be instructed. We'll meet those dates.
We're all busy people. There is no benefit to anybody, any of us, for having a deal stuck in a process for 2, 3, 4, 5 weeks when it could have been done, you know, in 10 days, 2 weeks. We as a lender, we don't make any money until that money is out the door. You don't make any money, you guys, until you've completed on the case for a client. So, you know, our interests are aligned, really. You know, if we've bought into the deal from day one, and I know one of your questions, Beth, is coming up in terms of goalposts and things, but if we all know what the case is from day one and we're bought into that, it's managing a process, and that is for us as a lender to be on top of our solicitors and valuers, as it is for you guys and the introducer community to be on top of the clients and their solicitors. To me, it's not rocket science. It's just common sense that everybody buys in day one to a timescale and works to it. Yes, things don't always go to plan, but you know, you manage it through the process. If there's a problem crops up, deal with it. Let's deal with it together.
I think as a broker, I'd like to add to that is we try and get the whole team together for the client. You know, from a broker's point of view, it is important, as Mac mentioned, you know, it could be a family solicitor that the client is bringing on board, and they've dealt with them on numerous things and they totally trust them, and they've never done one bridging loan before. And you bring the guy on board and the lender is saying we can move very quickly, and the solicitor is saying I don't know where we're going with this, you know. And I've had an instance where the solicitor has been advising the client against the bridging finance. So we do try to just make sure the client is aware that the team is of utmost importance. And from Dave's point of view as a lender, again, the lender has to be totally honest, you know, with the team that they use, and see whether we can meet in the middle, or we say, this is our team, will you work with our team? But it's all down to the whole rounded team. And I think as brokers, it's important to give the client that option and that information of who the team needs to be, as well as the lender pulling together. And I think if those areas are covered, as well as the client being very transparent with the asset, if you need to go out and see the site as a broker, I think you need to go and see if the client is not 100% sure. If you have a good relationship with the lender, they will probably come with you even before everything has started. They will see the site and everything can be ironed out to stop the situation which Dave said. You know, you don't want to get to Thursday completing tomorrow and you have 10 things that you have to deal with. All these things should be sorted out day one.
Totally.
Moving on to the way that bridging lenders are funded, which is one of the most integral elements of this conversation. How does it affect the way that they lend and make decisions, and how quickly they make decisions as well? Stuart, do you want to kick us off on that one?
I think this is by far and away the biggest issue for me in terms of kind of non-delivery. I mean, many bridging lenders just do not have, number one, capital. So it's pretty easy to kind of go out there and, you know, find a high net worth individual that's, you know, some cash sat in the bank account, not paying a right lot, and saying, should we do some bridging? What that doesn't do is give you capital and equity to be able to weather the storm in certain situations. So for us, we started day one with our own money, which I think is pretty important. You know, there's not a huge amount of bridging lenders out there that've got their own cash invested in. We have never been in a situation where we haven't been able to fund the deal out of our own resources. So what we do is sell down certain deals in certain situations to third parties and do make a margin on that. But we're always in a position where we can do that deal ourselves. Managing the flow of capital and equity, the rate you pay, we actually kind of dynamically price the kind of call lens that you bring into the business, because it's important that that we make money. If we don't, then I think it can kind of throw the dynamics completely out of the lending situation. And what just kind of scares me to death is the number of lenders out there who borrow money on relatively high rates with fixed terms, and are forced to get that money out of the door, because if they don't, it just starts to cost them heavily. They start to make really, really bad decisions as a result of that. So we're paranoid about this being a short-term lending business, and therefore our sources of finance have to be short-term to match the term that we are putting out to our clients. Otherwise, I think it just doesn't work. So we're happy to pay more for that flexibility. I think if you bring in longer-term funding at a lower rate, I think that can then slow you down there, because I think I think as we said before, if you're having somebody else kind of wagging a dog, it can then also affect that decision-making process. So we actually spend as much time, if not more, looking at the flow of capital into our business than making the sales. Anyone can say we'll sell this at whatever rate, whatever loan to value. But if you've not got the money and think, oh, I've now got to go and find it, it's just going to cause problems. It's going to, they don't think about the reputation of the broker, letting them down. They just don't think it's easy money, and then it's not. And the level of experience you need to actually be able to understand this stuff is a lot greater than don't get me wrong. There's a lot of British business out there that understand this stuff very, very well, but a lot don't, and they're going to come really unstuck if they're not very, very careful about it.
Just adding to that, Beth, it's who if you are funded, it's who your funding lines are provided for. And let's, and a bit of a flippant comment here, but the whole point of bridging is we need to fund an asset which is either, that there are tight time scales, or the asset is in a position that it's not ready to be placed in the mainstream market. If you as a bridging lender are funded by another lender who is more mainstream and they are in control of the decision-making process, then you've just got to start to ask questions almost at the outset. Yeah. Is the experience, is the understanding of how bridging works aligned between any provider of funding lines and the people who are making the decisions? We invest a hell of a lot of our time in with the co-investors, co-lenders we work with. They have complete transparency on all our transactions. We don't pool anything. Every participant knows a transaction, as far as they need to know the transaction. But more importantly, we have our money in from the beginning, and we've still got our money in at the end.
Yeah, exactly. And we've also educated our co-lenders on how important it is that they deliver alongside ourselves, because otherwise we have the same problems that we've just been discussing.
Mm-hmm. But I think one of the massive problems here at the moment, and this really does worry me in the space of new lenders, is what I call the bridge bank effect, where basically you package a deal to a new lender who, with respect, don't even show it to the actual line of credit until you're almost getting to drawdown situation, and this is frightening.
Well, we actually approach it completely in reverse, Mark, in terms of we present to all our co-lenders exactly what the situation is, what our margins are, what our fees are, what we keep as a business, and then if they then want to co-participate, they can do. They're not obliged to. So I think being super transparent through that capital chain is also important.
But Mark, that conversation happens the minute we put terms out on the deal.
I agree with you and yours, Dave. I think what I'm concerned about the market is there are more like almost master brokers who are serenading as being lenders with respect to just collecting stuff to put to a lending table, and this can be at the 23rd hour. In a situation. I mean, I go back to an old story of mine from Bridge Bank 15 years ago when I was doing a portfolio property in Blackpool, and 2 days pre-drawdown, the big bank came back and said, we don't like property in Blackpool. Well, for the 3 months up to that, they haven't moved from Blackpool. So it literally was only when it fell on the desk of the person who signed it off, somebody actually realised, and it was just an absolute mind-blowing situation. And I just believe there are people coming to the market, and you said earlier, Beth, the entry level is so easy now. They can just portray this. We are a lender. They're not a lender. They're a master broker at the end of the day. I don't want to deal with that person.
Yeah, exactly. And I think there's also another area that gets massively overlooked and we are paranoid about is regulation. So not from a lending perspective in terms of the clients, in terms of bringing that kind of money into the business. And the amount of times I see situations where it just falls completely foul with the kind of FCA regulation, it's just unbelievable. And if that problem actually manifests itself in the business, it will cause massive damage to the business itself and to the borrowers. And I mean, we spend tens and tens and tens of thousands of pounds getting our documentation right, our processes right, and a lot of the new lenders out there just don't understand it or don't want to understand it.
It's easy money. They say it's easy money. It's easy return, don't they?
You know,
of the bridging market is unregulated, but regulation could very much, well be on the cards in the future if the bar to entry being so low, increases risky and irresponsible lending. So it's a
right. I think back we probably welcome some kind of element of regulation because I'm sure that we would be delighted to comply with that, and I think that may be a way to shake out some of these lenders that just don't have the same level of kind of care and attention on what they do,
I have it's more of a comment than a question, but it'd be interesting to see your thoughts on this from the audience and just on the funding perspective. They said it's interesting the way that peer-to-peer lenders are taking all the flack. Many bridging lenders who were funded by challenger banks all had their lines pulled and stopped lending. I assume that was at the start of the pandemic. Be interested to hear the panel's thoughts on this.
I think it's back to the same principle there, isn't it? Really, for me, it's all about think about your funding lines properly in the first place and understand that you will, in lending by its very nature, there's bound to be situations where you have to pause for a little bit and think and say take time to regroup. So, don't get tied into medium and long-term funding lines when you've got a short-term product. It doesn't make any sense.
It's just, there's more detail in the deal than people like Stuart mentioned earlier. It's not a straightforward industry, and people investing money into peer-to-peer lenders on the basis that they would guarantee the return, to me, it just jumps out as the next PPI claim situation. And I'm sure in time it's going to come, because I'm sure that a lot of old ladies, with respect to old ladies, who put money into situations where they thought they were going to get an 8 and 9% return on the money, so it was safe because it was going into property. It was never the case, and we steered away, and I'm glad we did with respect.
But I think it's fair to say that there are still some peer-to-peer lenders out there who are fine. They survived the pandemic. They manage their books honestly and correctly, but that's a reflection of the management in those businesses.
Agreed, Dave. Yeah.
And also probably that they've got money invested in the business as well.
I think the key thing for me, Dave, is don't borrow money from people that don't really understand what they're doing to lend it to somebody else. That's just morally wrong as much as anything else.
100%.
I'd like to just move this on to the goalposts conversation, which we've touched upon earlier. In what instances would goalposts of a particular loan be moved by a bridging lender, and how can this be mitigated by all parties within a transaction?
I would say for a good broker, they should do the due diligence not only on the funding but also the legal and the planning. and that's where it can come down. And the value of a good broker would be looking at the title register, the planning permissions, because they can always come out later on during, during the due diligence of the transaction once the terms have been agreed. So that's what I would do to mitigate them circumstances.
As a lender, I see probably, and it's not, 3 key reasons why goalposts may change. There's a material difference between evaluation between what's been presented to you and what transpires and comes back in paper. I will qualify that by saying, before we even get to valuation, the lender and broker should have complete clarity on how that is being instructed. Are we lending on market value, or are we lending on a different basis of valuation? If there's a material, issue that crops out of the legal process, some things can be handled through indemnity insurance, but I'm talking a material issue on the legals, or something's not been disclosed, a material credit issue with the borrower hasn't been disclosed. Now, back to what we said earlier, all those 3 things can be covered off largely at the outset. If the client has been completely upfront with the introducer, and introducer has then got complete transparency with the lender, those 3 things shouldn't, be raising their ugly head 2 days prior to completion. They all can be, benchmarked in some way. You can quite, particularly in a residential property, you can benchmark a residential value of a 3-bed terraced house somewhere in the northwest, and if it looks materially awry, then challenge it day one. To me, it comes down to that communication, honesty, and transparency. If we're going to say as a lender, and if lenders say they're going to do a deal, and that deal is based on a certain set of criteria, legal charges, valuations, then quite frankly, if they are ticked, they should deliver on that deal.
What's the point there? I don't think I think from a lender perspective, you should never move the goalposts. I think once you've made that offer there based upon the loan to value, etc., that should never move. If it doesn't value up, or the legal position isn't as presented, that's a different issue. But we will never move the goalpost, would we? If we made an offer based on specific terms, we will never ever move it. I think going to the point about capital, I think the only time a lender would ever move the goalpost is if they're struggling to fund it and buying time to raise the money.
Yeah.
So
I think sometimes we've seen a trend the last few years where new entrants come to the market. We did give them a go, use them, but the decision-making process was mainly personality driven. If they didn't fancy that deal, or they got out of bed the wrong day that day, they didn't want to do it, and they keep you waiting, and you and your client waiting. And as a business, we couldn't deal with that, to be honest, with our brand and reputation, and for the client's money, more importantly.
If you move the goal,
therefore, John, you get to 3 days before completion, and somebody says to you, well, the guy in credit had a look at this again and he doesn't like it for whatever reason. That is not a valid reason to change the goalposts, because that should have been handled up, right at the outset when you got an offer.
Dead right.
The thing is, going back to the earliest points, it's just, again, underlines relationships and confidence in the 2 parties involved, isn't it?
And I think as well, there's been quite a lot of focus here on the lenders moving the goalposts, and it's also important for new brokers coming in. I hear it quite a lot. We can package your deals up really well and present it to lenders to make sure we can secure you finance, and package it does worry me a little bit on what that exactly means and how much information they are offering up to lenders, and if they're hiding anything which will come out later down the line and actually impact a transaction. So that's also worth noting. We do have some questions, and I know we've just hit 12, so I'd like to just quickly fire them out now. We've got a question here. I think this is probably mostly for the brokers. What are the panel's thoughts on lenders who charge upfront fees? Discuss.
Don't do it. Simple, don't do it.
I agree. No.
It's just, there's no need. We all go into the transaction together. We're all going on the basis that we're here to deliver to the client. We don't charge fees up front.
Agreed. I agree with that.
Brilliant.
I agree as a lender.
I've got another question, flipping the script. How well versed and experienced and educated are new brokers coming in? We've had quite a lot of focus on lenders here. So what about the new brokers?
I would say the experienced brokers have probably been, I know myself and Mark have been in the mortgage industry before we were commercial brokers, and I think that gives us good ground and great experience. So, I mean, I believe that as a mortgage broker in the mortgage industry, you have to go through CMAP and rigorous training and qualifications. I think that should be brought into the commercial world, really, because you've got people who've come into it that's less regulated, but they do need that training, both on technical level and experience.
100%. It's a big industry now, John, isn't it? You know, when we touched into bridging 15, 20 years ago, you know, it was a Manchester market run by Mr. Mosen, whoever he fancied lending money to. You know, it's a very different market now. It's a big industry at the end of the day.
Yeah.
And there has to be some way of giving regulation to give the client confidence they're picking the right person, and likewise the lender's being regulated for where the money's coming from the right sources. And you know, it's not a back of a bag industry anymore.
No.
Yeah, I agree with the new brokers. I think you can't just be, oh, I'm a new broker today, so I'm going to do some deals. You know, I think there needs to be a great deal of training, maybe working alongside experienced, well-seasoned and experienced brokers to help you along the way. It is very complex and you don't want to lose favor with either clients or lenders. And that comes across very, very quickly. A lender will know what you're dealing with. Here is someone who does not have a great deal of experience, and the industry welcomes new brokers. But I think it's important to preserve our name by making sure maybe our peers, our brokers, are working alongside the more experienced brokers to preserve the name of the industry.
I mean, the frightening part. Sorry, the frightening part of the industry, and not being flippant from a broker's point of view, in the chain of the project, we probably earn more money out of the deal than anybody, and we're the less qualified than anybody, and it doesn't fit right. You know, I'm saying it as a broker, but at the end of the day, it just doesn't sit right. You know, why can somebody decide that he's not selling cars tomorrow, he's going to start selling finance? How does that work? I don't get it, but the industry allows it.
I think that's where the regulation argument, and I've been saying this for a while, I don't think that the entire bridging market should be regulated. I think from a broking perspective, there should be more regulation and there should be restrictions on how lenders on board. But that would probably be for a future subject. I think we can talk about that.
Down to you to sort. Down to you to sort.
Yeah. I would like to just do one quick whip round with everyone on what would be the promise which should never be broken, or what would be the biggest red flag when speaking to a new lender, or for PMJ, a new broker. So John.
I would say a red flag for me would be if they did not know the process or the market, and not only our market, but the legal market as well, the property market. Big red flag for me.
Thanks for that, John. Mark?
I'm totally with John on that. I think it's just identifying that the person knows all the processes rather than just a part of the process.
Bridget, biggest red flag?
Hesitance when you ask about the process. If they're hesitant, if you're not getting a straight answer, huge red flag. You want a straight answer. And sometimes you could ask a question as a broker, which is a difficult question. Will you lend on this? but getting a straight, quick yes can be a red flag, unfortunately.
And Nina, red flag?
Similar to what everyone else has said, is that it's clear from the outset what the process is and they know the answers. And I think also the ability to speak to the decision makers. If you ask to speak to a decision maker and they said, oh no, they're not, you're not able to speak to them or you can't contact them, that to me is quite a big red flag.
Stuart, red flag from a broker, the broker side?
I think if we speak to a new broker, we chat you through our processes and criteria, then we get a deal within 5 minutes, which doesn't hit any of the criteria or anything that we discussed in the meeting, then I think that tends to be a bit of a red flag for us, which does happen from time to time. So.
Fair enough. And Dave?
To me, property doesn't have to be complicated. So if you get something across your desk and it's written and comes across as very, very complicated, then somebody's trying to hide something. There's something underneath that, you don't need to overcomplicate a transaction, because there's probably only 2 or 3 fundamentals to it anyway.
Interesting final comment there. I'm going to have to kindly bring the event to a close. We're at 6 minutes past 12. Always go over slightly, I'm afraid. But thank you very much to PMJ Capital for partnering with us on today's event. And thank you to our fantastic expert panel for joining us out of your busy schedules. And I also want to thank you, our audience, for joining us this morning. We will be publishing this roundtable in full next week on Bridging and Commercial, so you can catch it there again. And if you enjoyed this one, we are holding these events almost on a weekly basis for the rest of the year on both Bridging and Commercial and Development Finance Today. So you can check out our events calendar on both sites to find out when the next ones are. For more insight and news, you can subscribe to the print Bridging and Commercial magazine, and you can see our latest one on our website on B&C. But I'd like to say have a fantastic afternoon to all of you, and we hope to see more of you in person soon. Thank you so much.